think it's slight positive that the Republicans are in power in the US at the moment. The world of early stage venture was open to me.
So how is your startup gambling is going so far?
But, c'est la vie. These are the risks that we are expected to take as early stage investors. The company had grown 4 times in revenue from the time that we invested to the time we exited. In the good times, you can afford to invest into vitamins, but nowadays everybody needs only painkillers. So either I'm asking all the right questions at the start, or no one else is asking all the right questions.
Good. So hello everyone. Welcome back to Investor Returns. I'm Ulyana Shtybel, and in this podcast we dive deep into the world of venture capital and angel investing. Every episode we bring you insights, strategies, and real stories from the top investors shaping the future. Today I'm joined by Colin Boey, and he is a B2B angel investor and syndicate lead. What is very exciting about our guest today is that Colin is actually not the only syndicate lead in a one syndicate, but in his history, he was a syndicate lead in quite a few syndicates from what I've been reading. And I would like to, Colin, just to welcome you on our podcast and give you opportunity to introduce yourself and tell you actually your story, how you got into venture capital and how you got into angel investing. What was your first angel investment?
God, it was so long ago, I don't remember. Thank you, Ulyana. So I fell into angel investing because of my background as an investment banker. We were fundraisers for companies of all shapes and sizes, and some of those companies were early stage tech companies, and that's basically, we as employees had the opportunity to invest into the deals that we were also advising on, that was basically how the world of early stage venture was open to me. Prior to that, I'd only been investing into the public stock markets because that was all I thought we had access to. It was super interesting to learn that there was this world called startup land or early stage venture. As soon as that was available to me, it kind of felt like a light bulb moment. It actually, I don't know whether I want to go into this, but I had been playing quite a bit of online poker prior to that as well. And so, I like the little bit of gamble that comes with online poker. And I think the startup world adds that little bit of raciness to investing, right? The stars kind of aligned when it came to angel investing and myself, really.
Yeah, very cool. It's actually quite interesting that you've been doing the gambling. So how is your startup gambling is going so far? Was it successful?
I think it's par for the course, I'm guessing. I probably made the same mistakes everybody makes when they start out. Everything sounds like a great idea, right? All the founders all seem to have some sort of interesting idea that sounds like, oh, it's so different from everything else. If this takes off, it's going to be fantastic. But over the years, you get more gray hairs, you get more wrinkles, and I guess you learn how to double down on where your strengths are, etc.
And have you been having already some exits in your portfolio? And actually, just briefly, maybe you can share how big is your portfolio at the moment?
Look, when I was investment banking, I can't remember. We must have invested in maybe 15 or so opportunities back then, just random stuff, right? But then, what I consider my real portfolio is when I started becoming a full-time angel in middle 2020. That was when, I had a proper thesis about B2B SaaS, about software that was focused on automation, productivity, and efficiency. And since that time, we've invested in actually another 15 or so companies. And the exits that I had prior to doing this full time, I think those were quite fluky in a sense. We were also doing some of the later stage investments, so some of those flipped into IPOs pretty quickly for decent returns. But in terms of angel investing, my real portfolio now is, I guess, 15 to 20 thereabouts, and within what I'm doing now, since 2020, we've had one exit. This is quite an interesting story, actually. So, two female founders. The company started out as a marketplace. And to be honest, if I had seen them any earlier, it probably wouldn't have been very interesting to me. But by the time I got to them, it was a Series A, and they had basically created a SaaS product for one side of the marketplace that they were heavily selling into. So, basically they were vertical SaaS before vertical SaaS was even a trendy term, right? And I had a lot of respect for the founders. We were investing late 2021, so top of the market. And I think you can see where this is going. And then, 2022 happens. They tried their hardest to try and get to cash flow break even with the fundraise that they just closed. Some startups are like ships at some point where it's very hard to turn them around very quickly. So no surprise, I suspect they weren't able to really get to full. I think they were cash flow break even on like some every now and then, every month or so, but not on a consistent basis. So they were either faced with a follow-on fundraise, which at the dumps of 2022, 2023, were probably going to be highly dilutive and down rounds, and so they decided to exit. The company had grown 4 times in revenue from the time that we invested to the time we exited, but unfortunately we got out with just all the money we put in. So it was a flat round, but under the circumstances, I think flat is the new up, right? In the current environment. So unfortunately, not the outcome we would have liked, but happy with the process. We spotted a good opportunity. We spotted a company that was going to be able to grow, and it's just unfortunate that other circumstances, meaning the lack of follow-on funding, unfortunately, was a bit of a shock. But c'est la vie. These are the risks that we are expected to take as early stage investors.
Yeah, exactly. Everyone who is listening to us right now and new to angel investing should definitely understand that it's a very risky investments, and returns could be high, but also the losses could be significant. So in terms of exactly, probably on that note, because I have a lot of questions, but like how you diversify your portfolio, how you minimize this risk. Do you invest still in some other asset classes? Do you diversify between different stages of the companies?
Yeah, so personally, I still have a public portfolio. I guess that's what I consider to be fairly safe, albeit, I like technology. And so, even in listed companies, there can be big down rounds or big pullbacks that can give your net worth a bit of a shock. But, in terms of mitigating risks, I guess that's kind of my, what I've learned over the years, right? Clearly, you need to take risks in order to get outsized returns, but so long as the risks that you're assuming are commensurate to the return profile, that's when it can be quite interesting. So typically, we look for companies that have at least some sort of traction, some users already using the product, where we can then conduct customer references, etc., and then from there work out whether or not there is something there, right? Otherwise, it's just a little bit too difficult for us.
And what kind of actually industries you feel comfortable with? Any specifics? It's B2B SaaS.
Yeah,
Any
B2B SaaS, and fairly agnostic. The few things that would tend to stay away from, for example, like health and wellness, if selling into hospitals, for example, is just so difficult, right? Like, for example, I know the NHS system here. I know the NHS is constantly asking the government for more money. That's not the type of customer you want to try and sell software to, right? If they can't even pay the frontline workers, the doctors and nurses enough money without having to pass the hat around. Software is just a very low priority for them. Albeit, I'm sure anything that is able to automate their processes is going to be good for them. But yeah, it's just too many other variables to come into it. And kind of same sort of thesis is like other industries that I find difficult, challenging to operate in. If you're selling into restaurants, selling into real estate agents, for example, businesses where it's not very difficult to set up a business, must have quite high natural churn. Hence, as good as your product is, if you've no idea whether or not your customer is going to stay around due to no fault of your own, that's another tricky business to be in. What we do like, professional services, selling to law firms, accountants, financial services, for example. What I also classify as professional services, selling to other software companies too, right? So very, very agnostic. They tend to be very, very agnostic, but yeah, there are a few no-go zones for us.
Yeah, for myself, I kind of started to divide this SaaS into two categories. The one which is actually supporting operations, and it's very often could be very important piece of the software, but it's a lot about the nice to have, and you need probably then to sell to large organizations who has money actually for this operation efficiency, to spend on a software which gives the efficiency to organization. And then the another type of the software, which is actually something that actually helps organizations to make money, and without which they cannot exist and cannot run their business. So what I mean, having that many actually this SaaS, there's CRMs on the market, right? There are still plenty of new CRMs because it's actually the tool that helps to grow sales, and which mean make money, right? And it's very different two type of the products when you have the nice to have product in operation, and the product which is essential to the business to make money. And so in terms of actually how you define the product in the size of the market, like how you measure the size of the market when you look into the product and the business to understand if it is actually interesting for you.
Yeah, so one of my key criteria is it has to be a problem felt across the world. So it needs to be a global problem. And, straight away, that's going to be a big enough market. But yeah, I really, what you said just then resonates with me because it aligns with my thinking of what is a vitamin, what is a pain relief, right? A painkiller. And yeah, in the good times, you can afford to invest into vitamins, but yeah, nowadays everybody needs only painkillers.
Yeah, exactly. Most of the time, it would be the case. And this smaller organization is to which you sell, the less they need any kind of the vitamin, right? So
Yeah.
it might be some kind of the larger organization enterprises. They're more acceptable to the vitamin products. But if you want to sell to the mass market, SMEs, it's definitely not go. Uh,
No, yeah, I agree.
yeah, and in terms of geography, so you actually you invest globally, right? And
Yeah.
can you maybe just dive in a little bit into your syndicate, right? Or, because I saw that you have been involved with a couple of syndicates. Are you currently involved with the one, or actually there are a few that you're still running? And what geographies they invest?
Yeah, so yeah, I don't know if the confusion is with the deals that we've done in the past. I have a network of like-minded investors who love the intellectual stimulation of investing into early stage, mostly software companies. And for the most part, when I find a deal that I want to invest into, I will then share that with my network. But sometimes it's not just if I find a deal, sometimes I have collaborators out there who, yeah, work with me when they have a deal that they're working on, and then we will, yeah, pool resources, we'll pool SPVs, etc. So yeah, some of the other SPVs that you saw my involvement with, I think that's probably what you're referring to. But you know, for the most part, you know, my network is just about, yeah, 150, 200 investors now, and you know, we are globally distributed, and the UK is just yeah, a part of what we do. So, in terms of what we invest in, you know, yeah, for us UK taxpayers, SEIS and EIS is fantastic, but it's not the be all end all for us, you know. So, and you know, the US market, if you can find, look, the US valuations can appear to be quite expensive compared to some UK and European opportunities, but for the, you know, it's not a apples to apples type comparison. You know, the US is also a much bigger market. You know, much deeper pools of capital. So full on funding risk is typically less than how it is here. They've got much deeper pools of talent. Although, you know, with AI, who knows whether the talent is even all that required anymore. And yeah, but you know, again, deep pools of customer bases to sell into. So yeah, we love the US, we love the UK, of course, for tax purposes. But then, yeah, I think I'm of the mind that you know, good startups can come from anywhere, right? You just need that spark of a great idea. You know, all the technical universities are so strong nowadays. It's not like you know, a technical founder in France is that much, you know, worse than the technical founder in the US. Yeah, all the trainings, etc., and yeah, it's all fairly homogenized now.
Yeah, I actually it's very interesting what you say about really that I would call it actually paying a premium in valuations for the certain benefits that are offered by US market, because as you mentioned it's probably easier to raise capital there next round,
Yeah,
access to talents, bigger market, which I would put definitely on the first place. And kind
yeah,
of that's also the reason why you probably want to pay this premium, because you know that this company is more likely to be successful. What uh,
exactly.
what about late stages? Like, do you do sometimes the late stages? Because we have a lot of syndicates on Quorum who actually, if they do investments in US, so they would especially do a lot of late stage opportunities and even
Mm.
secondaries.
Yeah, that's an interesting one, and certainly from a diversification perspective, I see the benefit of having companies of all sizes. The where I find challenging with late stage opportunities is that a lot of these deals, the information, it doesn't come from a primary source, right? So it's typically some earlier investor now looking to diversify their holdings, or it could be employee pools, looking to cash out a little bit. But there's always, if it's employees, it's usually a little bit of a wrinkle as to, can they even be open about whether they're selling, etc. Um, those employees might be able to tell you what's going on in that company, but you're not really getting, the most up to date numbers. What is their growth rate? What their churn is, what their LTV to CAC is. It's key information that investors need to have in order to make a decision. That's the bit that I find most challenging. Finding somebody willing to part with their shares in XAI or OpenAI. Yeah, I see those opportunities 3 a week probably, right? But yeah, I just can't get comfortable based on a very short deck, and in a way, I almost feel like the people who are selling it are just selling on the side of FOMO, right? Hoping that somebody is willing, OpenAI, they're going to get to AGI, so invest now. It doesn't matter what the valuation is, it doesn't matter what they're growing at. None of that matters. It's just the brand that matters. And yeah, look, I could market myself as having been an investor in a bunch of unicorns by now if that was the case. But end of the day, I'm looking for returns, right? And for me, for the risk I'm assuming, I like to see like at least a 10x type return. And yeah, it's not clear based on just public information how those investments are going to work out. So if I can get access to primary information, if the founders would agree to do a very quick Zoom for myself and my syndicate members, yeah, there's a good chance we'll invest. But otherwise, it's very difficult. And if we're only investing between $150 to $300,000 into each opportunity, yeah, it's not going to move the needle for founders at that stage. So yeah, it's just not a good fit, I don't think.
Yeah, I think that restriction of the information that you can get is definitely a big thing, because you cannot get it directly from a company. And even if the early stage investor received this data from a company, they are not allowed to share it publicly unless a company approve it. So big problem for private secondary market. uh, Many
Yeah.
players have been trying actually to solve it, but this informational problem, as well as the liquidity problem, is still there. And that's why I think the best way of doing the secondaries is, of course, when a private equity firm is going directly to a company and offering to do the acquisition of, let's say, 20-30% from early stage investors, which later on done through the tender procedure. And with a tender procedure, because there is actually the founders involved, so then there is a disclosure of the information, and private equity can get the information exactly from a company. I know that there are opportunities. I might be mistaken, but the platform Equity Then, I think, offering secondaries, and they trying to disclose as many information as possible. But it's yeah, I would definitely have some concerns the same way they you do. But I see these deals happening, And sometimes brokers or manage to get this information somehow also from a company recent, I don't know, like uh, maybe even get some of numbers approved from the company. But definitely it takes the efforts of the syndicate lead and probably the broker who is arranging this deal to find out the real data on it.
Mm-hmm.
But totally agree, it's not the formal that anyone should follow, but rather fundamentals that are associated with this kind of the companies. And yeah, beauty of is that you can still invest in a Series A, Series B, but have direct access to the founders, because as a syndicate, opposed to as you would do as a single investor, right? As a syndicate, you can get this information from founders.
Yeah.
Do you feel a competition, by the way, when you like trying to get a best deal and you come as a syndicate? Do you feel a competition with the funds?
Yeah, of course. Look, I'm just one person, and the funds typically have, lots of employees, lots of associates to, they're spreading their tentacles far and wide. And one might argue those funds provide that little bit more brand recognition, which can be quite helpful for startups too. But I would argue that is it better to have one partner who has, I don't know, 15 other investments, and have that sort of focus on you versus a syndicate of 50 angels who might be very helpful, who can be, you know, who can help open doors to the customers, etc., who can be, shoulders to cry on if the founder needs it. Look, I think to be clear, as angels don't have as deep pockets as VCs, and sometimes you need that sort of VC sort of checkbooks in order to be successful in that particular startup. But I think that's where it's getting interesting now, where AI is taking playing a very, very big role in the development of software companies. I heard recently that the most recent YC batch, something like 85% of the companies there were maybe not quite vibe coded their way into existence, but AI played a very big role in how those founders put their companies together and put their products together. Could it mean that we get to a stage where we don't really need as big of a dev team as before, and hence fundraising requirements to hit breakout velocity is much less than previously? Yeah, possibly. And maybe if we're lucky, maybe some angel investments can be one and done and hit breakout velocity and become unicorns just off the one external funding round possible. So it's quite exciting for what the future brings.
Yeah, it's actually quite interesting that the speed to unicorn, like the time to unicorn, like shrinked. So it's much faster right now to get to 500 million annual revenues. And I think the fastest recently company who get from zero to 300 k in revenues annually it's been like in 3 months, uh, and it is because of AI. So because of dev and sales are becoming much more automated, and if they have actually hit the market with the right product, so in that case, actually the angels can see their returns much more faster.
Yeah, there's an AI coding company called Cursor in the US. I think in 2 years they went from zero to $100 million in ARR. yeah, that's just incredible growth.
Exactly. And I think it's very interesting, actually, the companies who sell to AI, mega companies, because there is, for example, scale.com. They are doing the mapping of data, and they are selling their client is actually OpenAI. And we had this deal through one of our syndicates. Uh, so I know a little bit
This
about it.
scale AI, these are yeah, they provide human labeling to so they help with the data enrichment for all the AI companies, right?
Yes, and the company revenues are so impressive. Like it's hundreds and thousands of millions. Like really, and the company been on the market like for probably 2 years or something. Yeah, it's impressive, and I think it's a new way of companies who can support the AI growth, not just AI driven products, but actually how you feed AI models. Right, this is a very very different, interesting angle. But coming back to the branding, actually, what is the name of your syndicate, and how investors can join it?
Well, actually, I haven't even bothered with branding. I created a company when I started doing this, and I was struggling to come up with a name that meant something to me. And then my wife told me a funny story, actually, about how the Snowflake founders, um, how they came up with their name is only because they like skiing and they like snow, and so I basically copied their I just basically copied their playbook, and I went, I love snowboarding, and there's nothing better than snowboarding in Deep Pow. And so yeah, that's what I called my company, Deep Pow. But actually, in hindsight, yeah, it does have some investment connotations as well to it about how, when you go snowboarding, you want it to be dry powder, right? That's the best kind of powder to have. And I like to think that my angels and my angel syndicates have decent dry powder to invest into, yeah, the next interesting B2B SaaS company to come out.
And how someone can join you?
Well, reach out to me. I'm available on nearly all the social media platforms. Cold DMs are very welcome. Um, yeah, it's very easy to get hold of me.
Yeah, to everyone who is listening to us, so please uh, contact Colin. Like if you want to join the syndicate, syndicate is the best way of actually starting your angel investing, because otherwise you definitely gonna run into a lot of mistakes. With syndicated, at least some layer of the diligence that are already done, and the knowledge that share the group of investors share, and actually like how eager are members to share their knowledge, and you mentioned to support the company, right? So how involved your members are?
Look, I think most of my members have full-time jobs, so they're quite limited in terms of how much they can do. But that's the value that I bring, right? I do all the legwork of at least curating the best deals that I think are available to us, and only presenting the ones that I want to invest in. You know, hopefully that tells them that some level of diligence has occurred already. It is exactly what it means to them, and but we also get the opportunity to have a group call together where everybody can ask their pointy questions. Some of the more inexperienced investors get to hear some of the more experienced investors ask much more nuanced questions, and that's basically yeah, that's basically what you get from experience, right? When you're inexperienced, you have first order level of thinking, and then as you become more experienced, you then see deeper into the problems, and I think that there's no better way of learning than by seeing other people do whatever it is, the skill it is that you're trying to emulate, right?
Yeah. So you have the WhatsApp group probably, right? For your members.
I tried doing that. We had a Slack going on, but it felt like trying to keep everybody. It felt like too much work trying to keep the conversation going. So nowadays it's just very simple. It's I see a deal, I send out an email, and then those who want to join the email will reply, and then on the call everybody can talk about it, I guess, and comment, and then. Yeah, if there is any need for, I've also hosted Zoom calls where we analyze the financial models together. If there were one or two that find it valuable, if they want to, happy to do that. But yeah, otherwise it's just a lot of asymmetrical conversations. It's just people asking questions, me answering. Trying to keep that community vibe going, ongoing, I think is important. And I think people can learn a lot more. But, I guess I have to weigh up the trade-off of how much time it takes on my part. Yeah, there's I don't really get a lot out of it myself. So I think happy to do it if it didn't require as much time and effort.
Yeah. I think conversation might be really very time consuming. What I saw syndicates lead sometimes doing is creating a WhatsApp channel just to
Yeah,
as a channel to inform about the new deals and actions,
yeah,
but move the conversations into the calls, as you mentioned, because on a call you actually have the proper discussion. And also, do you do startup pitches or just a discussion about the opportunity?
just one. Yeah, just one opportunity. I think, short pitches. Well, yeah. So my model is slightly different. I only share the deal when I'm fairly confident I want to invest in. And so, of the 15 investments we've made so far, actually, let me rephrase. I've only taken 16 deals to my network in the past, and we've invested into 15 of them. And the one that we didn't invest in actually wasn't because we decided it wasn't a good deal in the end. We never even got a chance to get to that. The founder decided that they wanted to continue bootstrapping. And so, yeah, we lost the opportunity post taking that meeting. So I think because there is a lot of curation happening on my side already, investors, when they join my syndicate, know that I'm only presenting, what I think are the best opportunities we have at any point in time, as opposed to, and I know people who might do, you join a call, there might be 6 companies pitching, who knows which one is going to get funded. Yeah, I don't know.
So
I never share deals that I don't intend on investing myself, and there's no way I can do DD on 6 companies at the same time. Yeah, so I don't know. I have no idea how they do it. Maybe they've got a lot of employees. Maybe they've got a lot of interns to do a lot of the due diligence for them. But yeah, it just doesn't work with how I do it.
yeah, so basically founders just pitch you and then you get the deal to your syndicate.
Yeah, so I do the first call, and then once I'm fairly confident that I want to invest, I will then share it with my network, and it's an additional opportunity for someone who might have more relevant experience to flag maybe a risk that I might not have thought of. And so it's still possible that if it goes out to the group that we might not invest. But like I said, we've taken 16 deals to the syndicate. We've only not invested in one. So either I'm asking all the right questions at the start, or no one else is asking all the right questions, so we're all making the same mistakes. Who knows? It's one or the other.
Oh, you being in investment banking, so you definitely have some experience to ask the right questions. Time will show, right?
Exactly. Yeah, the long arc of history will know for sure whether or not. And you look, I think I know I'm gonna, of the 15 investments we've did, three have gone down, have failed already, right? So there
Mhm.
will be failures, but we are investing into a very high risk, high reward asset class, and yeah, all investors need to go in eyes wide open to that fact.
Yeah. By the way, I know how some syndicates do six companies in the same time. They take usually co-investment opportunities when there's fund already doing the due diligence. So they only join whereas the fund responsible about due diligence. Then you probably can do that, but then but it's getting harder to join on a pre-seed or sometimes even seed stage, because still on a pre-seed it might be only angels and a syndicate joining. On a seed sometimes also it's founders not open yet to have a fund joining.
Yeah. And, look, I hope that I've been curating a network of, like-minded investors who enjoy the intellectual stimulation of analyzing companies and making calls. And so that's why, a lot of the times when I see deals, the lead investor has not yet been determined. In some cases, we might make a decision before that even happens because we're getting maybe preferential deal terms, etc. Yeah, if we find conviction, we're very happy to move on that on that conviction. But yeah, it's different when you're relying on other investors to do your due diligence for you. But it's so this is well actually one of the my earlier lessons as a rookie angel. you know, Founders or other co-investors would remind me, oh, this very smart fund manager is invested into this, or this very smart high net worth individual has invested into this. It must be a good deal. And yeah, unfortunately, what you don't know, if you don't know why they're investing in that opportunity, there's no way of you knowing whether it's a good opportunity or not. That high net worth individual might just be supporting a friend, right? And actually made no due diligence whatsoever. You just never know. He might have or she might have might put 20 grand into something, but actually, he or she spends 20 grand on a bottle of wine on a Saturday night. That's a different risk to reward calculation that they are making versus what you are making. So, yeah, it's I don't like to rely on other investors.
Yeah, it's quite a good approach to make up your own mind. And about red flags, maybe for founders who are listening to us, right? What are your red flags in a startup?
Um, Red flags. I mean, look, I don't think I've ever truly identified red flags, right? Because, for me, automatic red flags are if they're doing anything illegal, right? But everything else is just little, your little spidey sense going, is what they're saying, does that make sense or not? If there's maybe inconsistent messaging in certain things, yeah, those are the telltale signs I might have in whether or not the founder really knows what they're talking about, has really done the work to get to wherever they are. The obvious red flags for me are I don't invest in crypto. So if it's a crypto deal, that's a red flag that's gone. But I think you're asking for a more nuanced answer as to why do I say no to a deal? And yeah, most typically it's if it's outside of B2B SaaS, And if it's a very niche market that I don't find very interesting, or if it's more of a vitamin and a nice to have versus something that can help generate more revenue. Those tends to be the reasons why I might say pass on some certain deals.
Yeah, Colin. Kind of understand it. And your aspiration for the future of venture capital. What do
My
you want to?
aspirations for the future of venture capital as a whole, all of venture capital, I think it's getting very, very tricky for the fact that more and more capital has been flowing into VC. This is why companies are taking way longer to exit. If you look back in the day, Amazon had to IPO by a certain stage, right? Because they needed to raise more money in order to in order to expand. Google was exactly the same. Facebook, when it did so, exactly that. But yeah, there's been so much capital flowing into VC that some of these companies can stay private forever. And then, what does that mean for the rest of us, right? Without liquidity, without recycling of capital, I think it puts a bit of a freeze on the VC market. And we've seen that when the IPO markets in the last 2 years, because they've dried up, it's basically winter in VC, except unless you're an AI company, right? Only AI companies have been able to raise in the last couple of years. And I think that's a sign that the ecosystem is not that healthy. But how we fix that's someone else's. That's way above my pay grade. I have no idea. I can just see that it's not going in the right direction, and I hope that we can make it easier to IPO again. Maybe, I don't know, maybe it's the short-termism of public markets that makes it also very difficult for startup founders to choose that path. Yeah, there's so many issues wrong that need fixing in order for it to be fixed, I guess.
I think London Stock Exchange is pushing a new initiative for private secondary market or something. It's called Pieces, or if I'm not mistaken. Let's see how this kind of the innovations gonna help to drive the capital market, and because it's kind of the closed cycle. If you have a lot of money, as you said, in venture capital, and venture firms keep investing, so no IPOs happening, and then you get as a consequences less LPs are actually interested to join VC funds, because if no exits, no IPOs, so obviously it's getting they're not going to be that much of the LP interest. And we see that actually there is a lot of dry powder, like sitting in family offices and not investing in VC firms any longer. So it's for VC firms, it's actually become much more harder to raise. And definitely one of those reasons is the IPO.
That's actually a very good point. When I said there was a VC winter, I was actually mainly talking about founders finding it hard to get funded because unless they were an AI company. But you're absolutely right. Both parts of that ecosystem are interlinked, and it's also because VCs are finding it hard to raise their subsequent funds, etc. Lots of emerging VCs. Basically zombie VCs companies now, right? Not able to raise full-on funds and have basically put all the fully funded from their earlier funds. It gums up the system for sure.
Yeah, a lot of hopes for IPOs now postponed to 2026. There were hopes for 2025. Now they moved to 2026.
Well,
So
I've heard Klarna is still trying to come out this year. who knows? I think we need maybe a couple. I know in the US, I think CoreWeave is talking about coming out. Let's see. I'm not hopeful. I think there's a lot of chaos in the world at the moment. And yeah, investors hate chaos. They want to know as much predictability as possible.
Yeah, in the end of the day, this probably also shifting the mindset and preferences of the you as a syndicate, because then you start looking more for M&As, right? For companies who can exit, who can be acquired. Do you feel that your selections are now a lot about like, okay, where this company gonna exit?
Yeah, that is definitely one of my key considerations before I invest. And I think it's slight positive that the Republicans are in power in the US at the moment, because there is talk that they might be slightly looser on big tech acquisitions, on tech acquisitions in general. If that is true, then yeah, perhaps it relieves the need for IPOs for recirculation of capital. But who knows? The current government is very unpredictable in what it's trying to do. So I don't have a crystal ball.
Yeah, exactly. There were a lot of hopes, which now have a little bit of the shadows.
Yeah, in November, when everyone's trying to commiserate themselves, like, oh yeah, okay, at the very least, we know Republicans are dependable on one thing and one thing only, being very pro business and pro pro economy, etc. But you sit here in March, you're like, is that even true anymore?
Exactly,
I don't
the
think so.
market's down, so so these hopes start to
Yeah,
disappear slowly. But yeah, hope it's gonna stabilize. We definitely need
not
also
hopeful.
we need the political stability for the economy as well.
We
So
do indeed.
yeah, Colin, it was amazing to have you on our podcast. Thank you for sharing your
Oh, my
wisdom,
pleasure.
inspiration for angel investors who are listening to us. Yeah, and I wish you good returns uh,
Yeah, me too.
and economic stability.
That's all we can ask for. That's all we can ask for.
Yeah.
Thank you, Ulyana. Yeah, by all means, anybody wants to see good deal flow, please reach out on LinkedIn.
And for everyone who wants to see our future episodes with more investors from the venture capital angel investing, please subscribe to our podcast and
Yeah, like and subscribe, please. Yeah,
like and
I've always wanted
subscribe.
to say that.
Yeah. Have a great day,
Yeah.
everyone. Bye
Thanks,
bye.
Ulyana. All the best.
And